Hey guys, how's it going? And wish you a very happy 2023. In this video, I will look back into 2022 and what an unusual year that was. As the Fed has repeatedly hiked interest rates over the past 12 months to contain the worst inflation in decades, the financial market have experienced a generational shift in its attitude towards interest rates. The Fed's effort have begun to pay off as the recent slowdown in price increases has been met with some optimism. It must be acknowledged, however, that the Fed's drastic action to slow the US economy have had a considerable impact across the globe. Wall Street saw its worst annual performance since 2008 financial crisis, with the S&P 500 dropping about 20% on Friday close out of a difficult year. The S&P 500 experienced a significant bear market in 2022 after 3 years of continuous growth, even while the pandemic raged on. It was an unpredictable year with Russia and Ukraine at war, inflation skyrocketing, the Federal Reserve raising rates for the first time since 2018, and ensuing concerns that the central bank's extreme tightening could push the economy into recession. Despite the rise in interest rates, the labor market has been able to remain resilient as a result of the falling interest rate environment that existed back in 2009 up to 2021. Many of the same strategies that worked between that period no longer worked. Bond yield surged, high-growth tech stocks sold off, and fossil fuel companies owned the day among many value stocks. There was a sharp increase in the yields of treasury notes in 2022, the highest level since 2018. In addition, there was a wide inversion of the yield curve between 2-year and 10-year treasury notes, which was the widest level in 4 decades. After years of low interest rates, an era came to an end where the cost of borrowing was cheap and investors were encouraged to take risk in the hunt for lucrative returns, whether it was on the shares of new tech companies or cryptocurrencies or bond market. Now, in 2022, the S&P 500 and Tesla have not hit their January 3rd peak. After that, on the last trading day of the year, that is on Friday, the S&P 500 was almost 20% lower than its level at the beginning of the year, making this its worst yearly performance since 2008. The Federal Reserve has warned that even as the US economy heads towards possible recession, its job is far from over. Inflation is still far too high despite the fact that it's starting to cool, and rates are forecast to rise further, so foretelling more pain to come. In late February, when Russia invaded the Ukraine and sent food and energy costs soaring, the Federal Reserve was faced with an even more daunting challenge because poorer countries are dependent on oil and grain imports to survive. And then the Fed started raising the interest rates in March. When central banks increases interest rates, they also increase borrowing cost, slowing demand and in theory tempering further price increases. This is the primary tool the central bank uses in order to combat inflation. In the past year, the yields on the 10-year US government bonds, which serve as the basis for borrowing cost across the globe, have increased by 3 percentage points, the largest annual increase since 1962. Consequently, mortgage rates, company bonds, and other forms of debt have gone up, resulting in higher borrowing cost. As a result of higher cost, companies are also less profitable, causing a downtrend in the stock market. And for the technology companies who were aided by low interest rates in order to grow, this proved particularly detrimental. Over the past year, the Nasdaq Composite Index, which is all about tech stocks, has fallen by over 30% in price. During this period, when investors lost money in the stock market and households were experiencing ballooning cost because of inflation, other more speculative markets also lost their luster. A new breed of amateur investors propelled the share prices of so-called meme stocks such as GameStop and AMC Entertainment upward during the pandemic, but their share prices declined over the course of the year. Bitcoin, one of the most popular cryptocurrencies, saw a wild price decline. Now, even though the US economy suffered from rising inflation, Europe was experiencing an energy crisis, and emerging markets such as Sri Lanka and Pakistan faltered. For the first time in 20 years, the dollar was worth more than the euro because of the relative strength of United States. The influx of cash helped push the dollar's value up as investors put their money in safe places and helped boost the dollar's value. A global inflation shock has sparked central banks to ratchet up their response, and with that, the debate has shifted from if they will win the war on inflation to whether the rising prices are here to stay due to supply constraints. In 2022, I got a key learning from the market that the Federal Reserve and interest rates are major contributors to stock market returns. This may sound obvious, but in 2021, after a strong run, many investors overlooked the incoming Fed rate hike despite the Federal Reserve's announcement and consequent actions. This led to a shock-induced selling when the policy was not as dovish as expected. In spite of the fact that the Federal Reserve has recently taken a more active role in the economy, the lesson remains the same, which is do not fight the Fed. In Chairman Powell's December 2022 address, he hinted that rate hikes would continue in 2023 and that the idea of cutting rates in 2023 would not be one that he was ready for consideration. And this is a valuable lesson for 2023 because many in the market may still not have realized the message. Although inflation may have peaked, but it remains well above Americans are accustomed to, and it has been this high level very steadily. And the Fed has made its intention very clear. Until inflation gets under control, rate hikes will continue. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.